All right, for tonight's class, we'll talk about our next chapter. And now it's basically our next week will be a chapter a week. So we'll go to chapter 12 next week, and then finally 15 is our last one. So we'll be wrapped up on May 7th as far as our workload is concerned. So for chapter 11, I did, just as a review here of the due dates, today is that pre-work, so if you could get that done sometime tonight, that would be awesome, that concept clip. And then the 22nd, or Monday of next week, is when all the assignments are due. And then finally, like I've done in the past for our tests, that is moved to the 24th, which is Wednesday night next week. So keep that in mind as you're going through chapter 11. So chapter 11 starts on page 591 of our book. The company profile is Herman Miller. And the reason I mention that, they are a competitor to a big employer in Green Bay, which is KI. So Herman Miller and KI make office furniture. And the profile talks about Herman Miller using one of the evaluation concepts talked about in chapter 11 called EVA, economic value added, and how that one measurement was used to improve their performance in reducing asset costs, specifically inventory. Inventory is a very expensive component for many manufacturing companies. So it's a good lead into what we're going to be talking about in chapter 11. So if you get a moment, take a look at that as you go through your readings. Our first concept, and you've learned it in maybe some other courses already, is this concept of decentralized or centralized type of organizations. Most large companies, because of their size, require it to be decentralized. Otherwise, there's no way we could get decisions made if one person was making it. Small companies, single owners, they still under the operation of a centralized, that owner, that person, that one individual makes all the decisions. So both are concepts that are still applicable today, just that this chapter revolves around the decentralized type of organization. And they talk about responsibility centers, which basically means breaking up the large company into smaller components. So those responsibility centers can vary in area, type, size, and who is responsible for that center. So the book talks about the types of decentralization, and on page 592, here's a comparison before we get to the types of decentralization. The comparison of the two types of organizations, like I mentioned, small, mostly here, large companies over here. So let's now take a look at the types of responsibility centers. Here's one type. You can organize the centers by product. So here's PepsiCo and the various product lines that they have, and each product line is its own center of responsibility. They own Gatorade, Frito-Lay, Tropicana, Pepsi, obviously, and then Quaker Oat. They're all independent and also generate their own financial information independently. And then they combine them into a consolidated income statement. Also, another type is graphic lines. So they talk about United Airlines being in this category. So they break their organization up by geographic area. Specifically, their Asia routes, their Central America routes, their European routes, and so forth. So that's how they decentralize, make it more manageable again. And then we call our next type of decentralization called responsibility centers. Here we're looking at these 4 different types. You need to know these 4 for the test. They are on page 595, so to speak, or on that 594. We got a cost, a revenue, a profit, and an investment type. So depending on the organization, some managers might be only responsible for their costs, specifically maintenance managers might be in this category, cost only. When we get to the revenue, we're looking at sales only. So here would be a sales manager would be in this category. And then we get, as we progress, to our next more responsibility, because now we have revenues and costs in our profit center. Here, an example would be an actual plant division manager, might be in this category. And finally, larger yet, again, plant manager may be involved with this. And what's added is the word investment to our particular type of responsibility, which means what plant assets do we or should we have in our possession? What plant assets do we need to generate that revenue, and what costs are associated with that investment? So we're going to basically concentrate on the investment center, and the best tool to use for that is called return on investment. Return on investment. It's a percent number. Basically, how much money or profit do I make on my investment dollar? That's the one we're going to really concentrate on, is that last one. Okay, so just some terminology to start it out. And there's some, again, here's how it used concept on page 595. So you can read that on your own. But let's look at how return on investment is computed. Page 596. So if you could go to 596. It looks like this. This is our first computation, number-wise anyway, for tonight. Very simple computation. It's not hard. We have operating income, which is basically profit, and asset dollars, called operating assets. Please know the definition of operating assets. I think it's on the next page. Yes, it is. So on page 596, Know the definition. What's income? Which is basically before taxes, right? Before interest and taxes. And the reason we're taking the earnings before interest and taxes is that these costs or expenses are non-operational, have nothing to do with the operation itself. Interest is a finance expense. Taxes is a finance expense. It's not an operation. When we get to the assets, though, look at what we're including. Cash, receivables, inventories like Herman Miller we talked about previously, land, buildings, and equipment used in the operation. They must be assets used in the operation. It would not include investments or goodwill or patent or any of those non-operational. They must be used in the operation to be considered operating assets. And then ROI requires an average of the assets, the value of assets throughout the year. And we just basically take the beginning assets on January 1st, we add the ending assets on December 31st, and that gives us, and divide by 2, right? That gives us an average throughout the year. So for this particular formula, where you're using an average throughout the year of those asset values. Okay, so on page 597, I have to correct this slide. This is not ROI. This is margin. Operating margin, to be specific. Operating margin is income divided by sales. So if you remember from QuickBooks, other courses, you have sales, you have cost of goods sold, and then you have margin, right? So you're subtracting the cost of goods sold from sales to get margin. And then you have a percent column, right? To get the percent column, you're dividing by sales. So 100% always. And then let's just say this is $10,000. This is $6,000. So this would be 60%, right? So my margin has to be 4,000, which would make this 40%. This 40% is exactly this operating margin. That's what we're dealing with. We're taking the margin in dollars divided by the sales dollars to get the percent. One thing I've noticed on this exam is that students, it's a simple division, right? But in some cases, they're not careful maybe, or they're rushed, or they're under pressure. They reverse the denominator and numerator. So if you could have like a sheet, maybe, showing these computations, just like a cheat sheet, I shouldn't say cheat, a reference sheet of these computations so that you don't get them backwards. Because again, you don't want to lose points on something that's easy to compute. All right, that's margin. The other ratio is turnover. Again, I'm going to change this to turnover. It's sales, dollars, over the average operating assets, turnover. Also known as sales turnover in practice. It is a ratio that's computed quite often. And what does it mean? That's what I want. Again, it's a simple division. But what does it really mean? It means for every dollar of assets we receive so many dollars in sales. So for every dollar of asset that I invest in my company, I generate so many dollars in sales. So with this particular computation, the larger the number, the better, right? So this number that I get, if I can generate more sales with fewer assets, right, the better our company is. Larger the number, the better. So if I can generate more sales with fewer asset dollars of investment, my company is stronger than another company with a lower sales turnover. Let's go back to margin. We haven't done, what does this mean? How many cents of profit do I get from every dollar of sales? So if I'm at 40%, what does that mean? That means I get 40 cents on every sale dollar. I make 40 cents on every sale dollar. So if I'm at 50%, it's better. I get 50 cents for every dollar. If I'm at 60%, I get 60 cents for every dollar. If I'm Apple computer, it's probably around that 90%. I don't know. I'm not just picking on Apple because their prices are so high. Right? So that's how that is discussed and meant, or what's the meaning behind margin percentage. 40 cents in our example on every dollar made in sales. We combine the two, margin and turnover, to give us ROI. So that's what they're crossing out here. And you'll notice here that what do we have left? Again, this is something that we learned in algebra. I can offset those two, right? So what do I have left? I have income over average assets. And that truly is the formula for ROI. This is the formula that yields our ROI, return on investment. And basically, what does ROI mean? Again, the meaning behind ROI is for every dollar invested in the company in assets, the company, we profit in cents of some sort, or dollars. It could be even dollars. We generate a profit of so much. So for every dollar invested in assets, we profit in some number. So here again, if I have a larger ROI than I did last year, the better. When I talk to clients, I give them your ROI was this. They don't understand what that means. So you got to explain what does that mean. And how does that ROI that we generated this month compared to last month, compared to last year, compared to 4, 5, 6 years ago? That's ideal for our management analysis. So, example 1 on page 598 then gives us our first crack at this. Again, simple computation. Here it is. Gives us a lovely little income statement. Tells us the value of operating assets at the beginning of the year and end of year. This is on page 598, if you're following along. And the answers are on the next slide here. So here are your computations that you're going to need for next week. We have to compute the average operating assets. And they're using margin and turnover. If we multiply these two, like we do in number 4, we get the ROI. Or we can compute ROI simply by taking the income over the average assets, which is 300. We get the same result. So some problems we will give you the information to do it in one step. In other problems I might just give you the margin and turnover and you have to do it in a 2-step process. So some of your questions are geared that way also when you do your assignments. You'll have to do it using 2 steps or just 1. Any thoughts, questions on ROI before we try one? All right, let's try it. Our first crack at this is obviously problem or exercise 26. Quick little formula or income statement. So sales minus cost of goods sold is margin. Less selling and admin expenses gives us our operating income. I put the word less there. Right? I've seen students add the 2 numbers together. So just a point. Everyone did their income statements correctly. That was good to see on their projects, so awesome. So we had 25 million in sales. $17 million, 500 in expenses. Oh, they didn't even tell us any selling and admin. I'm going to keep it there. So that leaves us what? 7.5 million? Apparently I don't know what the selling and admin are, so our operating income is 7.5 million. That's basically what we're looking at. All right, margin percent. Income. Over sales. Equals what percent? Is that 25 or
30%.
30%?
Yes.
So I put on these notes how the division is computed, just so we don't get them backwards. Sales turnover is the sales over average operating assets. Our sales were 25 million. What's our average operating assets? $10 million, yeah. $2.5, right? Usually a turnover is a rate or a number, not a percent, right? A margin is normally a percent. And ROI is income, 7.5 million, over assets, 10 million in this case, 0.75, or 75%. So again, it's just a simple computation. So if I were to write this out in a Word format, what does margin mean? We make 30 cents on every dollar sold. We make 30 cents on every dollar sold. Turnover means every dollar of investment in assets generates $2.50 of sales. For every dollar invested in assets gives us $2.50 in sales. And then finally, the last one means every dollar invested in assets generates 75 cents in income. So if I were looking at this company, 75% return is better than the market right now is around 7%. So very good return on my investment. So excellent. 75%, that's phenomenal. Another reason why this ratio is so popular used, why it's so, it's very much looked at by a lot of banks too, is that this gives an overview in one ratio the sales, expenses, and investment all in one number. It looks at all three aspects of a company's operation: their sales, their expenses, and their investment level in that operation in one number. So it's a quick review of that company's success or not success. Huh? That's why it's so popular. All right. We'll catch up later.
Yeah, I can't write that fast.
There is, I think, do I have one more? Yeah, 27. I guess we can do this one. Why not? I just wish they didn't have such big numbers, but I guess we'll try it. So these are listed 1, 2, 3. We're going to do the first 3 computations on problem 27. They've already given us the income statement, which is nice. The average operating assets, at the beginning of last year, they had 28,300,000. At the end, they had 23,700,000. Divide by 2. I think it's 26 million. Is that what it is? Just looking at the numbers. Looking at these two numbers, guys, looking at the 28,300,000 and the 23,700,000, is there a concern there? If you saw that on a balance sheet, if you're reviewing this company, is that a concern? They dropped their assets by what, roughly?
Almost 5.
About 5 million?
Yeah, almost.
Or something, right? Is that a concern? It's more than 10%, closer to 20, right? A 20% drop in your assets, I'd be a little concerned. Not that it's a bad thing, right? Maybe they have too many assets and they got to get down quickly. But in 1 year, that's a big drop. All right, let's take a look at their operation then. Because remember, if you don't have assets, you can't generate sales, right? Assets drive sales. So that is a concern for the future. Income. Operating income divided by sales, 156 million. Divided by sales, 1 billion, 40, yeah. Never worked for a company that large, trust me.
15%.
Is it 15?
15%.
How's that margin? 15%. Not too bad, right?
Yeah.
For every dollar of sales,
15 cents.
they're making 15 cents, right? All right. Turnover. We're going to use our sale number, 1 billion 40, divided by average operating assets, which was 26 million. This is huge. This is a large number. 40. So every dollar of assets, I'm generating $40 in sales. This is not a typical manufacturer. This is more, must be service oriented to get to this quite high number. And then, what is the return on investment, which is the 156 million. Divided by the 26 million average operating assets. This just gives you an idea as to how it's actually 600%. So what is that? What does ROI mean? It means I am, for every dollar of assets, in this case, I'm getting $6 in profit. The only thing I can think of that can get that kind of level is drugs. Just saying. Wow, that's cool. Again, I've never worked for some company that had this kind of percent. There's a lot of money here, guys. Whew. You could roll in it. Wouldn't that be fun? So if I invest $1 in this business, right? I get $6 return. That's what ROI means here. For every dollar I invest, and this is per year, guys. If they maintain this, I get $6 every year for every dollar invested. Again, huge. Why is it so much higher? Because there's very little assets. So they're generating this huge dollars of sales either from, what can I say? Branding. I went shopping with my son for jeans. So I just sticker shop. $150 for a pair of jeans or something like that. Well, they were on sale for $100. These cost me $12.
Was that a buckle?
Yeah.
Yeah.
Yeah. Seriously? No, we're not doing that. You don't have a job. How can you do that? So we walked out. But anyway, maybe it's brand name, right? Or maybe it's more labor service that we can charge a much higher price for, and I don't need assets for that, right? So somehow I'm generating a lot of revenue off of non-asset amounts. So anyway. If you guys work for a company like this, let me know. I'll join you. Just keep that in mind once you graduate. Cool. Let's look at our next item. There's some things on how does this relate to your life on study habits. I don't think we need to know that. Oh, yeah. Here I do want you to know what are the advantages to using this one number. Here's the biggest one. In one number, I can look at the sales, the expenses through my income, and the third, right, investment, all in one number. So it not only encourages managers to look at their costs, right, but what do they have on their books for assets? This is what Herman Miller was really concerned about during their downturn. They had too many assets for the sales that they had. They weren't selling enough to have all these assets on their books. So they got rid of them. They got rid of their assets to get their operation more lean, you ever hear that word, and focused on making money again. So that's the beauty of this particular ratio. Lots of power in this ratio. On page 600, then, there are disadvantages. So know these also. It can be done or overdone, right? Like anything. Not everything is perfect. It can be overdone. And that's what this narrow focus means. I might have a manager that says, if you're going to pay me based on my ROI, I'm going to get it there, right? I'm going to cut costs, I'm going to cut assets to get my ROI number up. But again, that's a danger for future, right? If I cut expenses, if I cut maintenance today, that could lead to some, that's great for the short term. My ROI goes up, but long term it might have some very detrimental effects. So this is a very short run focus type of measurement and should not be used exclusively when evaluating a manager's performance. So we have to be careful. Okay. Now, residual income. Another evaluation technique. This is on page 602. This is our second evaluation computation. This is hard. Take a moment. Can everybody read this? So again, this is a drawback with ROI, a disadvantage, right? A company's ROI, what they want to make is 10%. Okay. This division is doing better than the 10, they're at 15. So if I have an investment that comes in at 12% return, this particular project, the manager won't do it. It's better than the 10, the company wants to do it, but the division won't. Because if they take this project with the 12 on it, that's going to drop their return on investment for their division. And if they're paying on their division's ROI, they're not going to do it. So that's a drawback, right? So this measurement technique called residual income allows the manager to see that it's profitable for the company overall. And that's the goal here, is we want to reward that manager for increasing that company's overall wealth. So hopefully that's what we can do here with this measurement. How do we compute it? It is a dollar amount. What does residual mean? What's left, right? This is profit is left after subtracting what? The minimum rate of return. So in other words, this is money left over after I paid back my investors, so to speak. That I've met their minimum rate of return. This is money that I can use then in addition to that return on investment. So it's residual, what is left. Example 2 shows us this computation. So here we made $48,000 for the year, not bad. We have about 300,000 in assets, average, right? So the computation for residual income then on page 603. So here's our average assets, 300,000. I'm going to multiply that by the company's minimum rate of return, which is 12%. My residual, right, what I have left over is 12,000. Here again, the larger the quantity, the better. The larger the number, the better. So if this year I made 12, next year I make 15, 15 is better than 12, right? Really, really simple again. Let's try 29. We'll only do one of these. 29, 29. First computation is the residual income. I already have the formula up here to follow. Take our operating income minus, you notice that I have parentheses for the order of operation, right? Minimum rate of return times the average operating assets. So for 29, 136, so RI equals 136,000 minus, oh shoot, I forgot the 400. Whoops. $400. What's the company's minimum rate of return desired? What percent?
9.
9. So in parentheses, nine times the average operating assets, 1,900,000. Very good. Wouldn't this be cool to put these formulas in Excel? Just saying. Would be nice.
It minus is 36,400 negative.
Yeah, I'm going to get this next. I'm just going to write this off actually. Minus 171, right? And it's a negative what?
36,400. 34,600.
34.6. And in accounting world, is a negative number usually good? No. So this is not good. So, did we make a profit though? Yeah, we did. We made a profit. But we didn't make enough, right? We didn't make enough. What was the return expected? The investors, the owners, were looking for a return on their investment of $171,000. Remember, we have $1.9 million invested in this company. They're only looking for a 9% return, and we're not getting it. So, at this point, the owner could say, well, I can make money in the market at 15%. I'm going to sell the company and do that. Right? I'd make more money than the 9. Well, I'm not even making 9. So let's take a look at what is their ROI. Let's take a look at that. Because that'll answer the second question. Is the ROI greater than or less than 9? So if I take the ROI for this company of 136.4, I divided it by the 1.9 million. What's my ROI? Anyone?
Yeah.
7%.
7%?
Yeah.
Yeah. So you will need to know this for the test. If the residual income is negative, right? The company's, oops, that's a bad percent symbol. Here's where the company is. 7% is less than the 9% desired return. When the residual income is negative, the company's return on investment, 7%, is less than the 9% desired. And vice versa. If that residual income is positive, the ROI for the company is greater than the 9%. Vice versa. Does that make sense? If the residual income is positive, then the division's ROI is greater than the company's desired 9% return. So know both ways, obviously. Oh, since we have this bad residual income, how do I fix it? You're the manager. How do I fix this problem?
Can we add the percent up? the 9% you can add up.
No, I don't want to make this bigger.
Oh,
I don't want that 9 to be bigger. I'd be in worse shape.
we have to get more assets,
No, I don't want more assets. What do I need to do with the
more
assets?
income.
Jungle.
I need to dump some assets, right?
Oh.
What assets am I going to dump? Which is the, you go through the plant, right? What are you looking for?
Broken stuff.
Broken stuff, not used, right?
Oh. So,
Drop unused assets. Drop a whole, look at GM, they dropped a whole plant like Janesville, right? That's what they did to get their assets down quickly. What else can we do? Hmm? No, that ain't gonna help us. We're making money. It's not that we don't have enough money. It's not making enough though. What am I gonna do here, guys? Because the owner's gonna be asking you, what do I do? Right?
Can we sell more?
We gotta sell more. Yeah. Raise prices on our sales, can't we?
And
Who's going to whine if you tell them to raise prices? What manager is going to really be mad at you? Marketing. Very good, Amber. Yeah. So you might get away with it. Because it's harder to sell something when it's more expensive. Hence my jeans. Yeah. And marketing doesn't like to be challenged like that. It's easier to sell something when it's cheap. I have a yin-yang for marketing people. They're needed, but
Not that much.
not that much.
Not as much as they think they are.
Right. There's a difference between marketing and taking orders. Right. Some think that they're marketing people and they're really order takers. That's my opinion. I'm not saying anything bad. Just my observation. What else can we do? We haven't touched on it yet.
the reduce the price.
Reduce cost, yes. What company gets, if I'm reducing costs, who in the company do you lay off first?
The freak.
Hmm? Non-essential personnel. right? That's easy. Well, maybe not so easy. Maybe it's your brother, right? Or family members. So, what area gets hit? Do we cut production? No.
Maintenance?
Last, no.
Maintenance.
Production is where you make your money. So if it's not production, where do you gotta go?
Maintenance.
Hmm?
I mean, how about maintenance?
No, they're production related. We
Oh.
need maintenance.
Salaries?
Pardon?
Cut salaries?
Yeah, whose salaries?
Management?
Yeah, Jill said it too, managers, yeah. Most often managers. Which managers? The sales or accounting? Guess who gets the cut first before marketing? It's gonna be you guys.
Oh,
Yeah. Yeah.
Marketing is the pride and joy of the company.
Yes. Why?
That's where the money is seen.
That's where the money is. That's how the sales get generated, right? That's just the way it is. So if there's a downturn, accounting usually gets hit first, or finance. Yeah. So, not that it's correct. I mean, look at all this knowledge they were learning from us, right? But that's how it goes. All right. Just kind of real life stuff. There is one more. I'm just going to save it. I have it completed for my day class. I'll just save it with my notes tonight if you want to practice it. Okay? I do need to touch on this one though, 42. Because 42 is a lot like your 25-point problem. But let's take a break first before we start this one. So I'm going to stop here. To look at two projects, air conditioner project, turbo project, and below it, I laid it out already. There are 4 possible scenarios. That what is the best scenario for our company to take? What road should we take? Should we do nothing, which is way over here on the right? Neither. Don't do either investment. Let's just keep going with the assets and the revenue that we're getting now. Do we do both, if I go left to right? Do I just do the turbo, or do I just do the air project? So that's what our analysis will look at, is to determine which of the 4 scenarios we should do. So the first task is to determine what is the ROI for the air conditioner line. It's the $90,000 of operating income for an investment of $750,000. It doesn't seem very high. So for our $750,000, I'm hoping to get $90,000 of profit off of it. Does that make sense for everyone? If I invest $750,000, I'm hoping to get $90,000 per year, right? Going next, ROI on this particular investment of $540,000. I'm expecting a profit of $82,000. I'm not quite sure why they have the 80 at the end. If you can estimate that good, you're pretty darn good. So let's just assume $82,080 to make the ratio come out. What do I get for ROIs then? Let's start here. What's my ROI?
12%.
12%. Thank you, Amber. Not bad. It's okay. Market's around 8, 9. How about this one on the right? It's got to be higher than 12.
15.2.
15.2. So on the surface, which project should we take first? The turbo one, right? It's the bigger number. Obviously, turbo wins. But now, what we need to decide, of the 4 scenarios, what should we do? So I want to start again way on the right side here. What's my ROI if I did nothing? So I'm going to just divide these two numbers, right? 4.3 million
Yeah.
by 28,900,000 of assets. That's ROI, income over assets.
15%.
15% even. That's where I'm sitting. So I'm the manager here. I'm sitting at 15 right now if I do nothing. Might as well keep going right to left. Why not? So, how Cengage wants us to do this analysis. If we do both investments, okay, that's where I'm at, both investments. I'm going to take this number here, let's start with income, 4.35 million. I'm going to add 90,000, and I'm going to add 82,000 to the 4.35 million. So let's do that. 82,080 plus 90 plus 4,335 million. And you should get 4,507,000 and our lovely $80 at the end. We do that not only for the income, so store that in 1 in your calculator. Then take our assets, 28,900,000 plus 540 plus 750. 30 million. 190 equals an ROI of what?
14.93%.
Ooh. So if you're the manager, I'm at 15. If I take both projects, now I'm down to 14. Would you do both? No way. Why would I do that and go down? That makes no sense. All right, let's just do the turbocharger. Here we go. We start here again with income of 4.335 million. We add the turbo, which is 8280. 4,417,080. We divide by 28,900,000 plus 540. $29 million. Oh shoot. 29,440. And I get what for an ROI?
15%.
And I'd like to go a little further, Cherie. I want to go to 4 digits here, because it is a slight improvement. It's like,
15,037.
yeah, it's not a big improvement, but there is a fraction of a percent. Thank you. All right, and then finally our last one. Start at 4,335 again, and I'm gonna add 90,000 this time. I get 4,425,000. And divide by, again, my assets 28,900 starting, plus 750,000. 29,650. Divide that out, gets a return on investment of 14 something, I think.
1492.
192.
Just
92.
Yeah.
There we go. So the winner is which scenario?
People tax
Yeah, this is the winner. This is the best choice, and that's what we're trying to determine. And it leads us to that best choice simply because, look at that project is generating a little more than where we were, right? That's what gives us the incentive then to take that project and not the other one. Using ROI. Now, look at problem 40, please. That is your 25-point problem. It's probably the shortest one in the whole book to finish. So that's good, right? After chapter 9, that's a good one to have. So, look at the requirements for problem 40 on page 637. Compute the ROI for the division if the radio project is not taken. Compute the ROI just for the radio project alone. Compute the ROI for the division if the project is undertaken. So here's the ROI, letter A. Where was I before I started, right? Here's the answer for B. What is the project by itself? Here's the answer for C. What is the project ROI if I do it with my other assets, right? So this is C, what we just did here. So that's what you need to do for problem 40. Where was I initially? Where was it, or what will it be if the project by itself? And then finally, what will it be together with my other assets combined, right? Now the project is very big. It's $4 million of additional equipment I'm going to have to buy in the hopes of getting $640,000 of income. That's the project. Again, big numbers from my book, but that's it. Where were we? We currently only have 3.6 million of assets with an income level of 725,000. That's where we were. Now, you're going to do that same concept using residual income in part 2. Same concept. And in fact, problem 42 has that same requirement. So let's look at 42 a little bit. I'm not going to do all of these because it's just redoing everything. So on the next page of problem 42, guys, is the residual income answers. Residual income answers. So again, I'm going to start, if we do neither investment, I'm going to do neither here. All residual income is taking the operating income and I'm subtracting what? The return on investment. What do I have left? Residual. So in this case, I'm going to take 14% is the desired company rate of return times the average operating assets of $28,900,000. I get $46,000. I subtract that from 4 million. Whoops. 45. There we go. Oh, too many zeros. What do I have left? 289. That's my residual income currently. You will have to do the same thing for problem 40. What is the residual income if I did neither? Next, let's do both investments just to get a concept of this. Our total income using both investments was 4.5 million. $4,507,000. So I'm going to do this in red. And $80 minus 14% times both assets added to the original of 28,000,009 gave us 30,190,000. 30,190,000. $4,226,600 minus 4,507,080, 280, 480. So looking at the two numbers, does it look like it's a good idea to do both? Which number is larger? Neither. So at this point, neither is still a better choice, right? And you do the others, just with the turbo, just with the air. And guess what? Which one wins?
Turbo.
Turbo, right? Because it's greater than the 14%. So this one will generate the most residual income. But there are occasions where residual income answer, the recommendation, will be different than the ROI answer. So that's what problem 40 is about. What do you think? And there's also a third part to problem 42. Instead of 14%, they go down to 10. And then again, the answer changes for the recommendation. If we go down to 10, the winner is both. Because remember the residual income. Under both, we're both above 10%. So that's kind of what we're looking at. So when we go to the 10%, the residual income will give you a different recommendation than the ROI recommendation. That's an example of that scenario, because both will be beneficial. All right, so I'll have the answer key complete for both the 14% range and the 10 in our notes for tonight. Okay. Our next evaluation, we got to talk about advantages and disadvantages. The advantages of residual income, page 603, 604. I'll just put 604 here. This encourages managers to accept a project that earns a return above the company's rate of return. And that's the goal here. Again, if we can make more than the minimum rate of return that the company desires, that's beneficial for the company, right? The problem with residual income here's the big problem. Absolute measure of profitability. Absolute measurement. So remember, this is a dollar amount. So large projects just because of its size and assets and dollars of revenue possibility have an advantage, right? The project may not be as profitable, but because of the volume, it's got more money attached to it. So larger projects have an advantage over smaller ones, and that is a problem. That is a problem with the residual income. larger projects have an advantage.
Oh, right here. Disadvantage.
This is a disadvantage, yes. Residual income disadvantage. It's got the same problems as ROI, that short run look again, because it's based on profit, right? So that's always a problem as well. So their recommendation then, because of this absolute measurement, is to use both ROI and residual and evaluate the performance, right? And that would be most beneficial. Okay. Next measurement. Economic value added. This is the one Herman Miller used. It's very similar to residual. Almost identical. With a couple key differences. Instead of before the tax, the first difference, after tax income. After tax income. But it's still before interest expense, right? Still before interest. And the second difference of economic value added, now we have to look for a different percentage. It's not the company's desired rate of return, it's the cost of capital. Sean, quick question. You're our banker. What is meant by cost of capital? Do you loan out your money for free?
No, there's interest charged.
That's what cost of capital is, the interest rate, right? You gotta make money, right? So that's the difference. So instead of the required rate of return for the company, it's going to be our interest rate for that company. All right, so let's try our exercise 3 as the example on page 605. Here we go. Economic value added, we're going to grab not the 48 this time like we did under residual income, we're going to take the 33. So just another warning, on the test, I'm going to ask you for EVA. I'm going to give you the required rate of return is 10%. The cost of capital is, oh shoot, that's a bad example, 10% here. The required rate of return is 15%. The cost of capital is 10, compute the EVA. Why did I give you that 15? Confuse you, right? Which percentage do you take for EVA? Do I take the 15 or do I take the 10? You take the 10, right? So again, be careful. Do I take the 48 for EVA? Or do I take the 33.6 for EVA? I take the after-tax amount. So please be careful, because the residual income answer will be one of the choices. That's just the way it is. So let's compute it. Here it is. It's simply the after-tax operating income, 33,600 minus 10% of the assets employed, which is 30. 3,600 is the EVA. If this is positive, you are creating wealth. Positive is good. Negative bad. Negative means the author gets very graphic here. Destroying wealth. It's a very harsh word. Probably the harshest word here. Negative EVA means you're destroying wealth. I'm not getting enough money to even pay the interest back, right? Is basically what I'm doing on this project. Interest on my investment. Because Sean's not very nice. He's not going to give me the money for free. He's going to charge me a bloody interest rate. Right? That's how it goes. So that's what we're trying to measure here. Let's try one of these quickly. Let's do 31, please. Because it gives us a comparison between two different divisions. And we get to pick which one's doing better, right? EVA, I got the formula up there already. After-tax operating income minus the actual cost of capital percentage, which is interest rate, bank interest percentage, that's what that is, times the capital employed. So we'll do atoms first. They've already told us the after-tax amount, so that's nice of them. So I'm doing EVA, 605,000 times, parentheses, 12%, oh my goodness, times the capital employed. Does every client get the same interest rate? No. Who gets the better rate? Better risk, right? Gets the lower rate. Those that are more risky get a higher rate. Banks got to cover their behinds, right, in case you default. So that's the scoop here. So I'm looking at 480,000 off of 605 is what?
It had to be subtract.
Oh yeah.
Subtract with the.
Yeah, but I got this messed up, don't I? $480 from 605 is
480.
125, right?
Yeah.
It's positive, right? That's good. So I'm creating wealth. Oops. Let's do Jefferson and see how they look. Their EVA, I'll do that in blue. Profit of 315 minus 12% on 3.25 million. That one I can't do. You have an answer?
Negative 75,000. Oh, that's the whole answer.
Negative what?
75,000.
That ain't too good. Is each division creating or destroying wealth? Yes. So we've got Adams. Adams is creating. Jefferson is destroying wealth. And then finally, what can Jefferson do, guys? We gotta fix a problem here. I do?
Sell more.
Good. What else? We've kind of done this already. Increase sale price, right? What else?
Reduce cost.
Reduce cost. What else?
Sell assets.
Sell our assets or lower our assets somehow. But we don't want to get too carried away because that's our moneymaker. What's one more thing that's not on our ROI scenario?
Cut salaries.
Well, that's reduced cost. Yep. Should we call Joe in maybe? Joe's the other baker in this one. He's not here. I gotta find a better rate. Holy Christ, right? Find new bank. Basically lower the interest rate. Would help too, right? Instead of 12%, make it 10 or 8 or whatever the case may be. Find another bank.
A supply curve illustrates.
Sorry. She doesn't.
All right. Which company has the advantage just because of its size? This is that absolute measurement, guys. This is the drawback with EVA, just like a residual value. The larger the investment, they have a distinct advantage than the smaller investment. So, because they can generate more revenue, more sales off of that investment than a smaller one. So that is a problem with this EVA. When you're comparing, you're not comparing apples and oranges. Well, you are, apples and oranges. You're not comparing apples and apples is what I'm trying to say, right? Because the asset value is different between the two companies. It's like Gary's drive-through compared to McDonald's. There's just no, you can't do it. That's where ROI is good, because that is not an absolute measurement. All right. Where are we going from here? Just got the advantages and disadvantages. This is on page 605, 606. If you have your book, can you turn to 606, please? Do you see the checkpoint on 606? Read the second question, please. What is meant by hurdle rate? Yeah, minimum rate of return. I just don't want you to be surprised when the author switches to talking about hurdle rate when previously we were talking about the company's minimum rate of return. So what is the answer to question 2? Oh, it's right there. Sorry. But it's a good question to ask because that's the type of multiple choice question you'll see next week, right? So if the ROI is 12 and the hurdle rate is 10, the residual income will be positive, right? Will be greater than 0. That's what I need you to know. So if you find those checkpoints, those are good little quizzes for yourself to determine if you understand the terminology, really. That's what we're looking for here. La, 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 la. All right. Transfer pricing. This starts on page 607. It's, guys, I'll be quite honest with you. This is not a fun little couple pages to read. I shouldn't say that because then you really won't look at it. Transfer pricing means if I'm in a decentralized company, I'm selling between divisions. So I'm in one division, I sell to another division internally. It's an internal sales price is what this is. And what I'm going to do is try to summarize this as best as I can. And there are a couple of ways in these couple of pages that they transfer prices at. So let's look at the 3 choices available. These 3 choices are discussed on page 608. Remember, managers for each division compete against each other, right? They each want a high ROI because they each want a bonus, and there's only so much bonus money to go around. So market price is one way. If part is sold to outside users. Right? If there's a market for your part that you're selling between each division, that's a great way to sell it. Use the market price. Then it's nobody's getting an advantage over another division. So that's easiest. Number 2 method, cost-based transfers. Cost plus markup percent. So if my cost is $100 and my markup is 10%, I'm going to sell it for $110. That's another way to do it. Cost plus a little markup. The final choice is negotiated. We have a ceiling, we have a floor, and we negotiate a price between, right? So the last choice, number 3, is the hardest, and combative technique between the managers, right? Because whenever you negotiate something, there's always a winner and there's always a loser, right? Now, no matter what you do or how fair you think you can be, there's going to be a winner and a loser. Okay. Combative, competing, right? Fighting. So I'm going to use, I better do this first. Terminology. We got to do it. Can you turn the page, if you're following along, to page
609.
Thank you, Melissa. 609. Perfect. This is a multiple choice question. I have yet to have a class that everybody in the class answers it correctly. So here's my attempt. If I can put a red flag on this, I would. My question is simple. Who sets the floor? Who sets the ceiling? The floor is set by the selling. The ceiling is set by the buyer. That's what I need you to know. Who sets the floor? Who sets the ceiling? Now, the tricky part is not everybody's here tonight. So to get to 100% is kind of hard. So tweet out to those that are not here. Who sets the floor? Who sets the ceiling? Okay. You guys tweet, right? No. What do you guys do then? You don't tweet, you...
Text.
I thought only older people texted. All right, enough of that. Let's look at example 4. Example 4 on page, starts on 609. Here's example 4. Alpha division and delta. Alpha is the seller. Delta is the buyer. So sometimes that's half the battle, is finding who's the buyer and who's the seller. So they have 3 scenarios here. Transfer at market, transfer at full cost in this case, and negotiated, I think, hopefully. So let's do number 1 first. Here's the market price, $14. I probably should discuss what full cost means, because that comes up in the problems.
Actual cost?
Yeah, that's our actual cost to make it. But what is the sum of?
Oh,
What did we learn in cost?
it's like
What is in our product cost?
the direct.
Direct materials, good job. Direct labor, variable overhead, and fixed overhead. The sum of those 4 is full cost. Please know that. Because sometimes it's full cost plus a markup, right? 10%, 20% markup. All right. So we got that definition here. So first question is, Omni has a transfer policy that requires a transfer at full cost. What would the transfer price be? Full cost was what? $9. Would Alpha and Delta choose to transfer at that price? No. I can sell it for what? 14. Why would seller sell it for 9 when I can make 14? So the answer is no. That won't work. Let's look at question 2 then. Omni has a policy transfer at market price. Okay, that's 17 or 14. Why do I say that? What would the transfer price be? 14. Would the Alpha and Delta division choose to transfer at that price? Yeah. Market price is fair, right? Whether I buy it internally or externally, it's still the same price, 14. Now let's do negotiated transfer. Question 3. If we can negotiate a price and sell internally, seller can avoid $3 of selling expense. So now it asks, because it's negotiated, which division sets the minimum transfer price? Who's the min person?
Minimum
Seller. Who's the max person? Then buyer. Delta was the buyer, right? Alpha seller. I hope that's right. Yes. Okay. So which division sets the minimum transfer price and what is it? So we said the minimum is the seller, and they can save $3, so $11 is the minimum by saving the $3. So they're no worse off, right? I can sell it for 11 and still make as much money as if I sold it outside because I have to pay this $3 per unit selling expense. What's the max? 14, right? So would the alpha and division choose to transfer somewhere in the bargain range? And the answer is sure. As long as it's between 11 and 14, right? So the answer is yes. So that's what they do on pages 607, 8, and 9, is go through that whole scenario. And their answers are there, obviously, on page 610. All right, let's try a problem and see if we can fine-tune this. The problem is 33, 34, and then we'll go to 35. So those are the next ones, and then we'll take our next break. 33, 34, 35. It shouldn't take us too long. Oh, I got the wrong page number there. It starts on page 635. We have a furniture division and a motel division. So buyer sets the max. Who's the buyer in this particular problem?
Motel.
Motel, yeah. Seller sets the minimum, which is the furniture manufacturer. there's a sentence in there that says the furniture division can sell all the dressers it makes to outside companies for $40. Does everybody see that sentence? Because that's critical in how we answer these next couple of questions. So, hotel is looking for 10,000 dressers, but seller can sell everything it makes. Seller can sell everything it makes. So let's look at the buyer then. What's the max that they'll pay?
40.
40, because that's what it is currently, right? What's the floor though? What's the minimum? Which one?
29.
Actually, no. Actually, no. It stays at 40. And the reason it stays at 40 is because of this. Right? Why would I sell it for 29 or something below 40 when I can sell it for 40?
Because they say they can sell all dresses
Yeah.
to outside, that means they don't care to sell for internal.
There's no incentive to sell it for anything less than the 40 then, correct? You'd be at a disadvantage. Now that'll change when we get to 35, but let's just keep going here. So, okay, that's not going to work then. So what is the full cost transfer price?
29.
That's 29. The next question is, do you think that the transfer will occur at full cost at 29? And again, that would be what? No. And why? Because
They give more money from outside.
we can sell everything we make for $40. We can sell everything we make for 40. And then another question in 3, does it matter whether the transfer takes place at the minimum or max? And the answer is no. Same number. Same $40 number. So it's kind of a boring question. Not much happening here. So let's go to the next question. See if this ties it in a little bit. So problem 35. We got the same deal, but what's new here?
The transfer package will be transferred to the also, I think that company have policy for all transfer price and negotiated.
Yep, we're going to use negotiation here. We have excess capacity, right? Their machines can make 50,000 units, but how many are they selling? 40. So that means I have 10,000 of idle capacity units that I'm not making, and my machines are sitting. So that's what's different in 35. I have excess capacity. Now questions 1 and 2, who sets the max? That doesn't change, the buyer does. And it's the ceiling, right? What is the max price? Doesn't change either. What is that? 40, because that's what they're paying now. 40. we get down to the minimum seller, which is the furniture dudes, right? But now that price does change. What do I mean by costs I need to cover? What does that mean? I don't know if I've ever used that term.
You have
I gotta cover, yeah, we talked about it a little bit about break even. What costs do I have to make sure I get paid for? I gotta cover these minimum ones. Which ones are those? I don't remember. I gotta make sure I get paid for the variable costs, right? Which ones are my variable costs?
the daily labor, pay for labor or material.
What did the question tell us these variable costs were?
14.
14. That's the floor. If I can sell it for $15, $16, I'm making money. What about the fixed cost? Remember, full cost was what, 29? So I have $15 because my full cost was 29, $15 in fixed overhead. Why is that not in that number? And the reason is relevancy. Relevant. I'd have this $15 cost whether I made the 10,000 units or didn't make them. So if they're out, it's the same amount under both scenarios, it's not relevant, right? To be relevant, it's got to be different under the two different scenarios. Now, the reason I mention this, 14 is the sum of material, labor, and overhead, because on the test, I'm going to say material cost was $5, the labor cost was $7, the variable overhead cost was $2, and the fixed overhead cost was $15. Set the minimum price. Do you include the 15? The answer is no. So that's what I want you to be ready for. What's relevant for this scenario is just the variable cost only, the sum of them. So this again is a good problem to keep handy on that negotiated price question. All right. So we have our negotiating range between 40 and 35. The division managers agreed to 35. Would this transfer occur? And the answer is yes. 35 is in the middle of the range. Well, not middle, but it's within the range, upper and lower limits. So we would transfer at 35. What is the change in profits for the seller?
For the seller, you have to subtract the cost.
The variable cost only, right? They're going to make an extra $210,000 of profit. Yeah, baby. By making those 10,000 units for a division internally. So that's going to make their profits go up 210,000. How about the buyer?
They have to subtract the cost of 40,
They were paying 40, now we're paying what?
35.
35. I've saved 5 per drawer, per dresser, sorry, times 10,000. They're going to make 50 extra. Make sense? So, is 210 fair compared to 50? That would be my question. If I were motel, I'd be, give me some of the 210. Why do you get most of it? Hmm? But why would the furniture get more of it? Is there not a risk to this? Are we truly going to make 21? What if I damage a couple dressers, right? Maybe it's going to cost me more than 14. I got to be covered for that risk. So maybe it is fair then. For the company as a whole, 260. I'm just adding the two together, right? Now I got to do something fun. So here goes. I want to prove this 260 number. Another way. That's the fun way. So here we go. Remember, the company is no longer paying for those units outside, right? So internally, I can keep that $400,000 here. But remember, I'm spending $14 on every one I make. That's $140,000. I subtract that, and this proves that 260 is what the company is benefiting by making the dressers internally rather than buying them from an outside source. That's hashtag awesome right there. All right? Just another way to look at what the company's benefiting or how they benefit. So is it a benefit? Darn tootin' it is. Cash flow for one thing, right? So very much so. Why would you give the profit to another company when you can do it internally? All right, let's take our next break here because we're switching gears after this one. All right, I do have one more transfer problem. It's 44. But like some of the other ones, this is another one. I'll have the answer key if you want to practice on your own. And I'll have the notes from my day class that have it completed. It's always kind of good to leave tonight and then try it like tomorrow or Wednesday or Thursday to see if it makes sense. So give it a whirl. Let me know again if you have any questions. The next section that we're going to touch on in Chapter 11 is the appendix. Again, it's quite a bit of reading, quite a bit of definitions, and it runs from page 611 to 621, basically. So 10 pages. It's the appendix. So this is on the test. It's called the Balanced Scorecard. What's a scorecard? It's basically a measurement tool, right? Bowling has a scorecard, golf has a scorecard. Well, this one's called a Balanced Scorecard. Emphasis on the word balance because it contains on it both financial, which we love to do, and non-financial measurements. Financial and non-financial measurements. So there are 4 parts to a balanced scorecard. You can see them on page 611. Here they are. There's a financial, which is, again, ROI, that kind of thing. That's found in here in the financial. There is a customer perspective. So this is 1. The customer is 2. Internal business process perspective. We're going to touch on a couple here. Cycle time is here. velocity is here. How do we compute those measurements? And another one that is used, manufacturer cycle efficiency. Those are in the process. Emphasis on the word process, which means how we do our work, how we get from start to finish in completing something that we're making for our customer. Or if it's a service, how do we get from the point of service starting to the end point? What can we do in our process to make it more efficient? And then finally, number 4 is really our learning and growth perspective. Employee training is a part of this section. We should be training our employees to run the equipment, to progress in the company, right? That's always a very important factor as we develop our employees to become better employees. So that's part of that learning and growth section. They're detailed, right, on those 10 pages of the types of measurements that are found in each of those. And I'm going to go to a slide that gives a kind of a summary of all 4. So bear with me as I search for that slide. I really don't want to go through each of these because you've already been sitting a long time. Yeah, this is financial perspective. And you can see the very common ones we've done already. Here's ROI under the financial, and here's EVA. Now, the reason I'm doing these, economic value added, the reason I'm doing this is on the test, there are a couple questions as to the relationship. This is the measurement, ROI, EVA. Which of the 4 does that belong to? Does it belong to the financial, which is what it is, or some other perspective? So that's all we're looking for here. So I have a problem that we're going to go through that gives you a series of measurements, and you have to tell me whether it's financial, customer, internal process, or learning and growth. If you want page numbers, let me just give you those so that at least you'll have them. The financial is discussed on page 615. This is just a summary of that. 615. The customer perspective is discussed on page 616 and 617. And there's some samples obviously in these pages. The internal process is a little longer because it's got some computations in it, that being cycle time, velocity, and MCE, manufacturer cycle efficiency. This begins on page 618 through 620. Yep, 620. And then finally we have our, I'm going to have to jump here quite a bit. We have our learning and growth section, which is on page 620 and 622 through 622. And that wraps up the chapter then. So This is that learning and growth section where you increase employee capabilities, their motivation, empowering them, right? That's what we're trying to do in the learning and growth section. So let's try a problem that handles this. It's problem 48, please. Problem 48 on page 642. A through K. So we have some measurements, ways to measure our performance, become part of our scorecard, right? There should be this template in your packet. So we have 4 choices. Number of new customers, where would that measurement best be used? Customer, right? So some of these are pretty self-explanatory. Some could be in multiple categories, though. And that is where we're going to now. Letter B, it says percentage of customer complaints resolved with 1 contact. Great measurement technique or tool, right? Actually, it's not learning and growth, it's internal, our internal process. If we can solve a customer complaint in 1 call, that would be pretty impressive. That means our operation is doing very well, right? So that's more, I was thinking it could be classified under customer. That might be another category. But the author feels that this internal process is the better one. Unit cost, it goes where? Financial. Yeah, very good, Aaron. Yep, it's a financial measurement. Cost per unit. Cost per distribution channel? Same. Financial again. Yep. So letter D is also here. Suggestions per employee. No. What's the other? Learning and growth. Yeah. If it's related to employee improvement, employee training, it's under learning and growth. Warranty repair costs. Now, I don't know. Where would you guys put it?
Financial.
Yeah, I would. That's what I was thinking. The author wants it under internal. And I think it's discussed in the pages that it's also internal. G, customer, right? H, which we're going to go to shortly. Internal business process is H. Yep. Cycle time, velocity. This is a fancy term for what? Strategic job coverage ratio.
Manager to employee ratio.
No, it's actually the ability to cross-train employees. So if somebody's sick on a machine, there's somebody that can replace that person, that coverage ratio. So that goes under what? Training, yeah. So it's over here under learning and growth. That is a big problem for many of these companies. It's hard to find skilled employees, especially on these multi-million-dollar machines. J, on-time delivery. Customer, yep. That's a customer measurement. And then percentage of revenue from new products. So that's financial again. Very good. So without reading those 10 pages, you did pretty well. Good job, guys. But that's kind of the goal on some of those multiple choice questions that you'll see on the test. All right, so there were a couple of other computations I want to touch on under the internal business processes, and that is cycle time and velocity. So problem 36, let's go to that one. They're not hard computations, they're just make sure we got them in the right direction again. When we're doing cycle time and velocity, there's a new thing here. It's called theoretical cycle time, which means it's perfect. No waste, no inefficiency. It's perfect efficiency. Can I say that? I know I spelled inefficiency incorrectly, but you get the idea, right? It's perfect. Unlike my spelling, it's not perfect. Is it right? I'll go with that. Thank you.
It doesn't look wrong.
It doesn't look wrong. Good. Wow. So, if we are perfect, we should be able to make 50,000 units. But we're actually making only what? 40. So what they want us to do first is compute the cycle time if it were perfect. Now, cycle time is how much time does it take to make one, right? How much time does it take to make one? So I'm going to take time over units. So in this problem, I had, in 1 month, 10,000 hours to make my perfect 50,000 units, which is what? 0.2, right? 0.2 hours to make 1 unit. That's my cycle time. But the author wants us to convert that hour measurement to minutes. So what do I do?
Time by 60.
Times by 60, right? So let's do that. So this in actuality is 12 minutes per unit. You wouldn't go to your manager and say, your cycle time is 0.2 hours per unit. You would say it's 12 minutes per unit, right? So we're going to compare that 12, that perfect time, to what we are actually doing. So again, we have time over units. We have the same number of hours, but we're actually only producing 40,000. So that was 0.25 hours per unit, a quarter of an hour, which if I multiply by 60 is 15 minutes per unit. So that's cycle time. Now, is it ever going to be possible that we'll get to 12?
No.
Probably not. There's always wasted time. There's always down equipment. There's not a day that doesn't go by where something goes wrong, right? So we can't always think that we're going to get to the 12, but we should shoot for it, right? We should get below 15, maybe get to 14 and a half or 14. Our goal should be to make our way to 12. We'll do the same thing under velocity, which is the reciprocal of cycle time. So instead of time over units, it's units over time. units over time now. So velocity is I can make so many units in an hour, right? That's velocity. So theoretically, 50 over 10,000 hours gives us 5 per hour. That's velocity. And if we're doing actual velocity, it's again units over time, 40,000 divided by 10,000 hours gives us 4 per hour. So they're not hard computations. They're very simple computations. But again, what happens on the test, I'm asking for cycle time and the student gives me velocity. So just be careful, okay? They're not hard. Just be careful. Does everybody understand what is the difference between theoretical and actual? Because they'll talk about theoretical in some of your problems as you do them. All right, the third computation, which is under this analyzing a process, right, our internal process. We're trying to determine how well we're doing on our internal process, is called MCE. Now, I've never encountered MCE in my lifetime other than in this book. So it's relevant, I'm sure, in many probably larger companies than I've ever been attached to. But what it is, it's just a measure of how efficient our operation is. It's value added time over total time. It's a percentage. It's a percent number.
We use that to motivate the lines.
Do you really? That's my first experience.
Yeah.
Cool. So, maybe you can't tell me.
Tell you what.
What is an example? What percentage is the line? What's the goal?
Each line is different.
Each line is different?
Yeah, like the shred line will have a lot of waste, so it's a lower percent.
Okay, yep, makes sense. All right.
Yeah, but I don't know about the goals memorized. They're trying to compete against ships. I know that.
Yeah. Ooh, yeah, that's cool.
Yeah.
Second shift is always hard to compete against first. Why is that?
I don't know. Some lines do better on second.
Oh, really? Oh, really? That's probably the person.
Yeah, it's the
Like-
people that you're working.
Makes a difference, does it not? We always struggle with second shift because it's harder to find second shift people to start. So are they as well trained as the first? No. So if the machine went down, they kind of, whoops, I don't know what to do. Yeah, the good old days. Okay. Total time is equal to value time, which is no waste, plus non-value time. So value time, which plus non-value is total. I always say the bottom number is the actual time. Oh my gosh. The author makes a big deal of adding value time plus non-value. Well, that's actual time, right? That's real life time. That's the bottom number. So you're comparing the bottom number to what? Perfect. This theoretical, no wasted time. Everything that I do today increases value to the customer. There's no breaks, there's no vacation, there's no waste, right? There's nothing, it's perfect. Everything's running perfectly. That's the top number. The example for this, guys, is example 6. Oh, no. Let me go back to this slide. here's what the author wants us to do. So we've got perfect time on top, right? No inefficiencies, which is where I start. This is the value process time. And then they add move time, inspection time, wait time. These three are considered non-value time. Waste. Now we can't get rid of inspections, but maybe we can reduce the number, right? Make it less time. That might be beneficial. Make our MCE go up, right? The goal is to make the NCE closer as you can to 100%. Now this is discussed, and there'll be some questions on the test on page 619. And yeah, page 619. This is on page 619. My goal again is to get 100% on this question. So let's see how we do here. So let's try then the example for MCE. Yep. Problem 39. Problem 39, please. Now they give us a lot of information we'll never even use, so bear with me. What is the perfect time, guys? What amount? How many minutes? 10. So here again, the author, instead of using the word perfect, theoretical. Get used to that word, theoretical time.
Processing time the same.
Yeah, so theoretical processing time is 10 minutes. So then the question is, what is the amount of non-processing time? In other words,
6.
yeah, it's 6. It's the wasted parts of our operation. Non-value added, right? Here's that wait time. What was another example? Wait time. Move time. Inspection, thank you. I was going to put something funny there. Sleep time.
This means no break.
Watch TV time. You know what it costs during the, how many billions we lose because of the basketball games people are watching on work? Billions of lost productive time. So that's what we're talking, and it is 6, right? We had our 16 minutes of actual minus the 10 perfect, which means that there are a total of 6 minutes of this non-value added time. So that's the answer for this non-processing time is 6 minutes. So then we get down to question 2, finally our MCE. Our MCE, again, the author wants us to do this.
Perfect time divided by actual time.
Yeah, really, why can't we just use actual time? Wouldn't that be make much more sense?
Yeah.
But this is the way the author wants us to do it. It makes no difference. It's 10 divided by what?
16.
16, right? What percent is that? 62.5. 3 places, right? Which then as a percentage is 1. So round it to 3 as a decimal, which is going to be 1 as a percent, right? This is what happens on the test. They get to this question. We'll put this in green. Wait time was 4. Move time was 1. Inspection time was 1. That's 6, right? And our perfect time was 10. So those are the numbers. Does it say actual time anywhere? No. So what students will do is do this. MCE is 6 divided by 10, 60%. And that's one of the answers. Tricky, right? Did everybody see what happened? I didn't give you the actual time. I gave you the value at a time and all the non-value at a time. So what did I need to do? This is what I needed to do, right? I got to take the 10 plus 6. Don't get tricked and do 6 over 10. Because that's just what? 6 is non-value over value. That's not MCE, right? It's value over actual. This is actual. That's what we're looking for. So many students get tricked on that one. That's 3 points. Sucks. It does. Because it's an easy computation. But again, you're on the test, you're under pressure, right?
Yes. It's time, right?
Yeah,
Oh, yeah, all the time.
It stops at 3 hours, right?
Mhm. Usually it's plenty. Now, this will be a lot less time consuming than chapter 9. So, because look at the computations are much simpler, right? So, that's good too. All right. I want to do one more thing if I can.
Let me say one thing. When they don't give you the actual time, we're gonna use perfect time with the whatever ways, right?
Yes, your goal is to get the Hirschfeld rate. Value added plus non-value is actual. Your perfect plus your weight plus your inspection plus your whatever, non-value.
Because sometimes they call value, sometimes they call processing,
Yeah,
sometimes they call
I know.
perfect.
Yep, that's what makes it tricky too, right? Theoretical. Well, what's that mean? Yeah, I get it. On your last couple pages, guys, is a little pre-test. I want to do at least the first page here. This one has some difficulty for some students. So what they want us to do here is we're looking at this ratio, right? Return on investment, which is income over the asset, right? Our return on our assets. How much profit are we making on our assets? So there are 4 possibilities, and there might be more than one answer, but in this case there is only one answer. Which one is true? Which one is true? Of these 4, which one is true? Aaron says the second one. Is there any more? I just said there was one, so I gave that away. Oh darn. There isn't any more. But does the second one make sense? We kind of went through this. I think we did we not? If our assets are going up, which is what it's saying, right? The bottom number is bigger, that's going to make our ratio come down. If the bottom number gets bigger, it's going to come down. So that's what you really need to work on that understanding. Just like if I make income go up, my ROI is going to go up. If my sales go up, my ROI is going to go up. If my expenses come down, my ROI is going to go up, right? Makes my income bigger. So lots of different scenarios. What can make it go up? What can make it go down? That analysis kind of thing, again, is critical. The computation, I know you can do it. It's just analysis that might be difficult. So practice that. Our next question here. Operating income is what?
So subtract the cost, right?
Yep, all the expenses, right? So I'm at 2 million minus 1.2 minus 3 gives me what? 800 minus 3 is 500,000, right? And then the average operating assets, you take 2.3 plus 2.7 is the ending, divided by 2 equals 2,000,005,
Yeah.
right? Very good. Margin is
Income divided by every asset.
yeah. No, income over sales.
Oh, I think income is not that turnover.
Yep, and then turnover is sales over what?
Every asset.
Yep,
Every asset.
yep. What's the margin? 25%, right?
Yeah.
Are we good? So margin is 25% times turnover is 0.8 equals what? 20%? And then to do it the other way, 500,000 divided by 2,000,005, right? Average operating assets. I hope that's 20%. You can get either way, right? So that ROI can be computed two different ways. So that's the goal with that second computation. Because I might just give you margin and turnover, you got to get the ROI, right? Residual income, are you guys okay with that one? Or do you want to go through it quick? We can go through it. It won't take that long. Because operating income we already have, so do we have operating assets. Operating income was 500,000. It's the same number as on page 1. 2.5 million was the average operating assets. So how do we get residual income, guys?
Operating income subtract
Yep.
with the percent of the minimum rate return.
Minus. Residual means what's left over. We take our profit, right,
8%.
off of the assets. So what is the company's desired minimum rate of return? Also known as a hurdle rate, right? If we get that terminology down. 8%, right? So 0.08 times 2.5 million is subtracted from our 500,000.
300,000.
So that's 200. So our residual income is 300.
Yeah.
So if I have a positive residual income, this division's ROI must be greater than the company's ROI of 8%, right? Has to be to get a positive number. So this division's doing much better than the 8%. And it was doing 20%, right? So that proves again how that relationship of a positive residual value corresponds to ROI. The division was 20 on page 1, which is obviously greater than the 8. So that's why we have a positive residual income. EVA question is totally a different company now. After tax, right? That's the change here. And cost of capital, which is the loan interest. So 120 after tax minus 12% interest on our asset base of 600,000. So is that 48,000? Creating wealth. Right? I've made enough money to pay the interest, basically, right? The interest on the borrowing needed to buy the $600,000 worth of assets. That's kind of the goal here. Think of Herman Miller again. This was a number they used to reduce their assets, to make their EVA higher. Our final page is transfer pricing. Kind of wrap it up here. I did add some things to here that are not, these are not in your problem. So please add this. Please add that to the problem. So of the $11 full cost, of that 11, there's $3 worth of fixed. That's what I'm adding. It's just too simplistic without adding that. We're assuming excess capacity here. So we have time, we have the machinery to make the 12,100 units. So that too is an important item. Otherwise, transfer would not occur. Not at a lower price anyway. So who sets the ceiling? Buyer or seller? Buyer. And the ceiling is how much?
Outside supply 27 something?
Yep, 27.75. So that's the ceiling. Seller then sells at the floor, sets the floor. Excess capacity, right? What cost is important? Just the what?
Variable.
The variable cost. What is the total of my variable costs?
855.
855. $11.55 minus 3, right? There you go. You move that up. So that's the ceiling range and the floor range, 855. So a transfer could occur anywhere between those two.
How about if they tell you full cost, but they didn't give you fixed cost, so we can use that amount? It's like some example that they give you full cost,
Yep.
but they didn't give you fixed cost. We're gonna use that full cost price for all, right?
Yeah, I'm assuming this was full cost, 11, and a portion of that was the $3 fixed. That was not part of the problem. I added the 3.
Oh, okay.
There's nothing in the problem that would lend me to say it was 3. But remember also what our variable cost must be. Just direct materials plus direct labor plus variable overhead. Because I may give you the information that way. And fixed was 3. Right? So we only want the variable here. All right, that's it, guys. I'm going to stop my recording. The rest of the notes I will put out there with the problems already solved.